Hello and welcome to the fourth and final episode of Chapter 4. Let me quickly review what we have already discussed, and I've got two more things to cover in this video, and then we're going to look at a comprehensive example at the end. So let me get on through this and see if I can cover this fairly efficiently. Remember that Chapter 4 is all about the buying and selling of our product. So when we buy our product, it goes into the inventory account. When we sell it, there are two journal entries to record. What you sold it for, I've got in the blue. And then you need to take the inventory off the books and take the cost of what you sold to the expense account called cost of goods sold. And I've got that in the pink. So in the first episode, we just talked about how that works, and we talked about the basic calculation of cost of goods sold, and then cost of goods sold is subtracted from sales to get gross profit. In the second video, we talked about when the cost per unit changes over time, and then you sell something, you have this question of, well, which one did we sell? And in most businesses, the specific order is kind of irrelevant. And so companies pick a cost flow assumption, either FIFO, LIFO, or weighted average. And the choice of that cost flow assumption really impacts what number goes into this journal entry for cost of goods sold. So really that's where that FIFO, LIFO weighted average came into play, was what number do we take out of inventory and take to cost of goods sold. Then in the third video, we talked about a couple of adjustments to the cost of purchases, purchase discount and freight in. Those are just adjustments to the overall cost of purchases, but the general calculation stays the same. The adjusted cost of purchases is added to your beginning inventory as you're calculating cost of goods sold. Two things I want to cover in this video. First, what happens if instead of selling a product, it just disappears because of employee theft or shoplifting or something like that? An important point to keep in mind is if you don't really understand your business, and if you don't really understand how much inventory you should have, if you're not keeping good records, if you don't really understand how much profit you're making, then you're not going to know if anybody has taken something or not. It's just all going to kind of disappear into the details. But if you are on top of your business and you understand how much profit you should have included in your sales, then you're able to kind of back into how much inventory you should have. And then when you go out and count it and compare to what you're estimating, then you're able to identify if you've had any kind of inventory shrink. Inventory shrink is the term we give to unexplained losses of inventory. If you're able to identify some shrink, then part of the number that leaves inventory would be going into that inventory shrink account, which is also an expense. So cost of goods sold and inventory shrink are both expenses. Again, if you don't really understand your business, and if you're not able to if you're not even aware of the fact that you're losing stuff, then whatever you are losing will just be kind of wrapped up in your cost of goods sold number. But if you do understand your business and you are on top of your day-to-day operations, then you'll be able to estimate how much inventory you should have and identify how much shrink you have experienced. So we'll look at a problem like that. In fact, let's just go ahead and look at that right now. So in the blue, I have a sample problem, and for the most part, I've got it set up here. says the Acme Corporation began year 20X2 with merchandise inventory totaling $53,000. So that's our beginning inventory, and I've already got that in the inventory account. During the year, the company purchased additional merchandise costing a total of $330,000. So we debited inventory, credit accounts payable for $330,000. So I'm going to go ahead and put that debit into the inventory account. I'm just keeping up with a few of the accounts here that are relevant to this discussion. And we also had total sales of $420,000. So debit accounts receivable or cash, and credit sales for $420,000. So I'll go ahead and put that credit in the sales account. $1,000. Okay. And it also says that these sales included 40% gross profit. If the gross profit is 40%, that means the cost of goods sold is 60%. So 60% of those sales is we had a cost of goods sold of $252,000. So I'm going to go ahead and take that out. So credit inventory for $252,000 and debit cost of goods sold for $252,000. So what I'm trying to represent here is just what's been happening throughout the year. So we've been recording transactions as they go. Don't get too lost in the details here, but I'm just trying to get us to some end of year balances. At the end of the year, a physical count of the inventory on hand totaled $32,000. Based on the inventory records, management was surprised by the low count and suspects the company has experienced employee theft. Okay, so we had a physical count of $32,000. Well, let's look at what, if we've been keeping records day to day on a regular basis, then in the inventory account, we would have what we started with plus those purchases minus what we have accounted for as cost of goods sold, and that would give us $131,000. Well, if we go out there and count it, and some of you may have been involved in taking a physical count of inventory at a company, and that's what you're doing. You're just double checking the records. And so if we count $32,000, that means that you compare the actual count to what should have been in there or what's expected, and we've had a loss of $99,000. So we have $131,000 in the inventory account, but we know we only have $32,000 on hand. So we need to adjust the inventory account to reflect the fact that all this stuff is missing. So some companies call this their book to physical adjustment. They're adjusting the books to match the physical count of inventory. So we're going to credit inventory for that difference, $99,000, and debit inventory shrink, which is an expense account. AJE, that stands for an adjusting journal entry, an end of year adjustment. So when I post that, $99,000 is credited to the inventory, a debit to the shrink account, and that leaves in the inventory account the $32,000 that we identified through our physical count. So with all that in our records, let me summarize some of that here. We've talked about how to summarize the calculation of cost of goods sold. And so that's there. And then that cost of goods sold goes to the income statement. So To get our cost of goods sold, it's our beginning inventory plus our purchases as goods available. And then I subtracted what we should have had, knowing that we had a gross profit included in our sales prices of 40%, then we would have had cost of goods sold of $252. And so we kind of backed in to what that inventory should have been. And again, that allows us to identify the fact that we've actually lost inventory. As I said before, if you didn't have any idea how much inventory you should have had, then instead of 131 right here, you would have had just the physical count of 32,000, and your cost of goods sold would have been 351. In other words, your cost of goods sold would have been the combination of those two. So it's a good idea to be on top, to understand your business and monitor it on a day-by-day basis, because if you're not careful, you could wind up losing a lot of stuff, especially inventory, and not even know it. So it's good to hire good people, but also to try to set in place control mechanisms, internal controls, to kind of monitor what's going on. Okay, so that's inventory shrink, which is an expense account. And again, let me emphasize, cost of goods sold and inventory shrink are both expenses. Both of them are temporary accounts that close at the end of the period. In addition to staying on top of your business and understanding if you're missing inventory or not, another way to monitor what's going on with your business is through what's called inventory turnover. So if you would, focus on the top part of this page for a minute. Now, inventory turnover, I have a little analogy in the textbook. Let me just kind of mention it here. Suppose you had a diner that had 50 chairs, but in that, and you were open for a 2-hour lunch period. And somehow, even though you only had 50 chairs, you served 200 people during lunch. Well, how could you do that if you only had 50 chairs? And obviously, the way that happens is the seating capacity is constantly turning over. People are leaving and then new people are coming in, constantly turning over that way. And so, what you could say, if you were just open for a 2-hour period, you could say that on average, everybody sat there for about 30 minutes. 200 people, 50 chairs. It turned over 4 times, and in a 2-hour period, that'd be about 30 minutes per turn. That doesn't mean everybody sat there for 30 minutes, but we're just kind of averaging it out. Well, you can do the same thing with your inventory. If you think about the number of people that were served in a 2-hour period, that's how many people flowed through the diner. So we want to capture a number that measures how much product passed through the system or went out the door during the year. And cost of goods sold will do that. So on the income statement, cost of goods sold tells you how much product you moved or sold to customers throughout the year. Now, the sales number also measures that, but it's measured in sales prices, and we're going to focus on the cost because we're going to compare it to how much we have in inventory. So if you take your cost of goods sold and divide by your inventory, as I have here, 315 divided by 60, that tells us, that gives us a number of 5.3. That means that that inventory was sold and replaced, sold and replaced, sold and replaced 5.3 times during the year. I say a year because that's cost of goods sold is coming from the annual financial statements. If we had 5.3 inventory turns during the year, we'll divide that into 365 days, and that would be 69.5 days per turn. So in other words, what that means is that from the time you buy your inventory to the time you sell it, that inventory is basically sitting on the shelf, in this case, for about 70 days. So that's a pretty good way to monitor how well you are managing your inventory. You certainly want to have enough inventory on hand so you don't run out, but you don't want to have a lot more than you need, because that inventory ties up a lot of dollars. It could spoil, whatever. So you want to manage how much inventory is on hand and how quickly it is selling. The inventory turnover is measured by cost of goods sold divided by inventory. So if your inventory turnover was too slow, you could address that as a manager by focusing on the inventory. You could just carry less on hand. Maybe you just have way too much on hand and it's just taking forever to sell it. So you could try to lower the amount of inventory you have on hand. Or another thing you could do is try to sell, in other words, more product more quickly. And of course, a lot of that has to do with marketing strategy, your pricing, your advertising, location, that type of thing. So you can address the numerator, the cost of goods sold. You can also address the denominator. I picked a couple of companies to compare, Walmart and Dillard's, just to kind of illustrate what's going on here. So for the most recent years, here's last 3 years, here's Walmart to the left in the pink and Dillard's over here to the right in the orange. One thing I thought you might notice is that their fiscal year ends on January 31st. Both of them end on January 31st. That's pretty common for a retailer because the Christmas, the end of year season is so hectic and chaotic. They'll put the end of the financial year a month out there later to kind of get past all of that busy period. All of these numbers are in millions. That's 523 billion for Walmart and 6 billion for Dillard. So obviously Walmart is much bigger. But if you look at their gross profit, and remember we calculated the gross profit percentage as the gross profit divided by sales. Well, even though Walmart is much bigger, their gross profit is a smaller percentage of sales. That means that their markup, their pricing strategy, does not include as much of a markup. And that would be pretty reasonable because we understand Walmart to be a low price. That's their strategy, is to be low price. And instead of making a whole bunch on each item, they're just trying to sell a whole bunch more, so they'd have lower prices and more volume. So Dillard's, not a very different type of store, very different type of strategy. So I'm just using it for comparison. But their strategy is not to have such low prices like Walmart. So their prices include a larger markup. And plus they might carry different types of items as well, of course. One thing to notice is that from 1 year to the next, just look how consistent. For Dillard's, their gross profit is between 33, 34%, right in there. Very consistent. Walmart, right around 25%, also very consistent. So, the mix of what they're selling may change over time, but they've got a pretty consistent pricing strategy across the board. What impact does your pricing strategy have on how quickly you turn your inventory? Well, let's look down here. Number of turns. Walmart, they're turning their inventory almost 9 times every year. Take 365 divided by that, that's about 41, 42, 43 days per turn. Very, very consistent. On the other hand, Dillard's is turning their inventory just under 3 times a year. So the days per turn is up around 130 days per turn. In other words, that product for Dillard's is basically in their possession for about 130 days before it sells. Walmart's inventory is on hand for just a little over a month, a little over 40 days before it sells. So again, it's a completely different strategy. It focuses, it's all impacted by the pricing, by the inventory management system that they have and how tightly they are controlling that. So, but it gives a manager an opportunity to focus on where they can make improvements. Okay, so we've talked about inventory shrink and inventory turnover. And now what I want to do is look at a comprehensive example that covers a lot of the issues that we've talked about in Chapter 4. So I'll make this relatively quick, but look at this example. It says Abilene Company has a beginning inventory of $20,000. So I've got that here in the inventory account. The following transactions occurred during the year. The company purchased $15,000 of inventory from a company in Denver with the following terms: 210 net 30 FOB Denver. Okay, so when we purchase that $15,000, we're going to debit inventory and credit accounts payable. So I'll go ahead and do that. Debit inventory, $15,000, credit accounts payable, $15,000. 210 net 30, we'll take care of the discount in just a minute. FOB Denver, now we're in Abilene. This is free on board to the Denver company. So Denver is not paying the freight. We are paying the freight. Now the next question is this freight in or is this freight out? Well, this is a purchase. This is incoming merchandise. So this is freight in, which is added to the cost of the inventory. We're going to debit inventory $500 and credit cash. So I'll post that, transaction B, right here. Including the cost of freight in the cost of that inventory, goes along with a more general concept, and that is anytime you buy any type of asset, the cost of that asset includes everything you give up to obtain that asset. So it's not just inventory. If you bought equipment and had to pay shipping on the equipment, that would also be part of that cost. So we've paid for the freight, and now we're going to pay for the purchase within the discount period of 10 days. We're going to knock 2% off. 2% would be $300. So we're going to make a payment of $14,700. Write a check to the vendor for that, credit cash. We're going to get rid of the entire $15,000 accounts payable because that's the nature of a discount. So we get to eliminate that entire liability with this discounted payment. So the inventory ended up costing us a little bit less, and we're going to credit the inventory account for that $300 discount, adjusting the cost of that discount. So again, the purchase of $15,000 had a $500 freight added to it, and a $300 discount offset. That was item C. We paid for the purchase in the discount period. Item D, we sell inventory costing $27,000 to a company in Dallas for $34,000 with terms of FOB Dallas. Okay, when we sell product, we always have to account for the sale, $34,000 in this case, what you sold it for. So I'll credit sales for $34,000. The debit would go to accounts receivable or cash. We also have to record the fact that we no longer have this inventory, and the cost of this is $27,000. Maybe we calculated that $27,000 using FIFO, LIFO, or weighted average, whatever approach we're using. So debit cost of goods sold, $27,000, and credit our inventory for $27,000. And we now have an ending balance in our inventory account of $8,200. And I've got a question mark next to that. Is that really our ending balance? Well, we're going to confirm that with a count. We're going to go out and take a physical count of our inventory. Let's take care of this other transaction. The sale was made to a Dallas company, free on board Dallas, meaning we have to pay the freight. We're in Abilene. So the freight company is charging $400 for this. This is freight on outgoing merchandise. We are selling it. So we would debit freight out expense, credit cash, $400. So I will take that to the freight out expense. And then the last item, it says a physical count of the inventory at the end of the year came to a total inventory on hand of $5,000. Okay, so we do a physical observation of the inventory. We only have $5,000 actually here. We look in our accounting records. Our inventory account says we have $8,200. Well, that number's wrong. We're missing some. So we're going to adjust the inventory to reflect that $5,000 count, and the $3,200 difference will be inventory shrink. Remember, inventory shrink is unexplained losses of inventory. So when I credit that, credit inventory $3,200 gives me a $5,000 ending balance, and the shrink, the debit, goes there. And now we can summarize all of these results. First of all, let's calculate our cost of goods sold. And we had beginning inventory of 20. We had some purchases adjusted by freight and discounts that came to a net cost of $15,200. So added to our beginning inventory and our goods available is $35,200. We know we have ending inventory of $5,000. So our cost of goods sold, ignoring any other information, would be $30,200. However, since we know some of that is inventory shrink, then we're able to actually separate out that inventory shrink portion. And so on the income statement, let's put that in a nice little aqua color. So our sales of 34 minus our cost of goods sold, 27, which we had in our books there, and that gave us a gross profit of 7, and then we subtract out the inventory shrink. So again, since I'm aware of what my inventory should have been because I'm keeping good records, because I understand how much profit is included in my sales and therefore what my cost of goods sold should be. I'm able to, from all these different perspectives, I'm able to identify what the inventory should have been, and we were able to separate out the inventory shrink. If that was not separated, these two debits would have been combined, and our cost of goods sold would have been $30,200. So to make this consistent, then I would subtract out the inventory shrink up here to get an adjusted cost of goods sold. I just wanted you to see how that came together. And on the income statement, freight out is a separate expense. Remember, freight in was included in the cost of the product, and therefore eventually is included in your cost of goods sold number. Freight out is a separate expense. Okay, that's a pretty comprehensive example. That's the end of episode 4. You have a number of homework problems, number of different issues in chapter 4 to focus on. Good luck with it, and be sure and study hard. The more you practice, the better you know it.